Continuing on with our income statements, one last thing I want to point out is based on a single income statement, you can calculate the gross profitability of the business as well as the net profitability. Gross PM meaning gross profit margin, net PM meaning net profit margin. The numbers that you use are sales, so $2,500 here as your top line sales, but you're dividing that by either the contribution margin, which is your sales, which is what it costs you to build the item, so $1,450 here, to get a gross margin of 58%, or you're dividing it by the net profit margin, in this case $694, divided by $2,500 to give you a net profit margin of 28%. That's a very high margin. I don't see many businesses with this high of numbers, but let's always be optimistic. I'm going to move on to the balance sheet now. The analogy in your real life to a balance sheet is your checking account balance at a point in time. So that number that appears on your ATM statement, or if you look up your account online, it's whatever that current balance figure reflects. And we know that that balance does not reflect, for example, a check we just wrote or a paycheck we're expecting. It is just everything that's up to that point in time that has occurred in our account. And it is cumulative. It shows the sum total of all activities, ins and outs, in terms of the assets and liabilities of the business up to a specific point in time. Again, these are prepared monthly, quarterly, but generally speaking, at a fiscal year, the end of a 12-month accounting period. Balance sheets contain three primary areas: assets, liabilities, and owner's equity. And we talk a lot about how the equations work. So you always have assets being equal to liabilities plus owner's equity. That is your basic accounting equation. You can rewrite that in several ways. And if you hear the terms net worth or capital, those are other names for owner's equity. Here is an example of a balance sheet. Horizontal format simply means that we're seeing assets on one side, liabilities and owner's equity on the other. Assets consist of items that we own outright. Items that are leased would not appear here. Prepaid expenses reflect, for example, insurance payments that we've made where we've prepaid for next month's or next year's worth of insurance, but we haven't actually received that benefit, so it's considered a prepaid expense. Here we see a really good description of how depreciation works. The value of this building in this case is $700,000, but we've had some accumulated depreciation on that of $70,000. The adjusted asset value is therefore $630,000. So here you're seeing the original asset amount less depreciation and what is now appearing on the balance sheet as the asset value. It has reduced over time because of depreciation. On the liability side, we see accounts payable. So if you purchase items with a purchase order, which means that you've received the goods and you've probably received an invoice from the supplier, but you haven't paid it yet, that's an accounts payable. Notes payable would only apply if you have taken a loan out for the business. If you have staff, you will accrue wages payable each week because you do owe people that money. You'll owe taxes, and that could be either sales tax or business income tax, or payroll and salary taxes. And then the interest payable would apply only if you had an outstanding loan. For most of you, current liabilities will really just reflect any kind of accounts payable that you have, and if you have staff, it'll reflect some of the wages payable information. Remembering that asset side of here is what you own. The liabilities, the long-term liability side, are what you owe on those assets. So your mortgage balance, for example, and your notes payable balance are shown here. Recognize that these are balances owed. On the other side would be what they're worth, and the payments get reflected on your income statement. So as you make a mortgage payment, that shows on your income statement, not here. When you subtract your liabilities from your assets, you show what's left in the business. Owner's equity, in this case almost $300,000, has been contributed by the owner, and that is effectively the balance sheet value of the business.